Every major stock market crash in history had clear warning signs, but most people missed them. In fact, afterwards, people said, oh, look how obvious this was. Today, I'm going to break down the patterns that hit you clear as day when we look back and see how ridiculously obvious the signs were that everyone ignored and then later claimed to see very easily. In this video, I'm going to show you exactly how to recognize the warning signs of a crash, how to protect your money, and ultimately profit while the world is in panic. Because if you're ready, you can remain rational and win big. Let's get right into it. Now, here are why stock crashes are always inevitable. Guys, humans are the same. We get greedy, we get jealous, we have FOMO, we build things up. These crashes are merely a good idea that gets extrapolated over and over and over again to a point of exaggeration. You can think about that now. Remember education? Oh, you can never go wrong getting a college education. What are people saying now? You can never go wrong owning a home. What did they say in 2007? You can never go wrong in buying this stock or that stock or whatever. And the recent history will tell you that that is true until it doesn't. And because humans are the same, and they'll always be the same, stock market crashes are inevitable. It is absolutely impossible to avoid them. When will they happen? We never know exactly when they happen. And there might be a few people who've called one or two, but they will not do it consistently and avoid those people like the plague. Now, what's the difference between a pullback and a true market crash? Well, a pullback can start and then it's in the process of a market crash. Or a pullback is merely that, just a pullback. Just a temporary drop on its way to new highs. And for the last 15 years, that's basically all the world has seen. You fall back 10%, you go right back up to all new highs and new levels. So you sit there and go, well, crash can't happen. Look at these things. And I love when I hear people say, Paul, you know why crash isn't going to happen? Because I don't see anything on the horizon that would cause it. That's the point. Crashes aren't caused by things that the masses see. Crashes are caused by things that we don't see. And it's also caused by valuation. The higher and higher and the more overvalued we go, the more likely we are to have a crash. Now, is it important to understand this so that you can sit there and get out before the crash? No, absolutely impossible. And the old adage of it's more important to focus on time in the market than timing is absolutely important. I have 1,000 apartments. I have businesses upstairs. I can afford to be out of stocks for the rest of my life and only collect 4 or 5% of my money. I can afford that, but most people cannot because they got to save for retirement. And you guys have seen me 1,000 times. This is the stock market value, but this is how the price happens. Unfortunately, most people look at this line as value. It's not the value. This is the value, and this is the price. And your job is we don't know where we are at any point along the way. We have no idea. So you just keep buying month in, month out, forever, and you're going to match the market. You want to know why? Because all those guys who wasted hundreds of thousands of dollars getting MBAs from Harvard and they manage money cannot beat the market. Everybody has the intelligence to do it. Who has the emotion for it? If you prepare emotionally, you're going to do very well. And when markets drop and when markets fail, you're going to be the person who says, this happens all the time. Remember what Morgan Housel says, every past bear market looks like an opportunity. Every future one feels like a risk. Guys, they're all opportunities. And it's super important to understand investor psychology in order to understand bubbles, because you'll realize that greed does permeate. Just go out there, and you're listening to this channel right now, and if you're new to the channel, go watch our other videos after this, because you'll get an idea of the way I talk. I sit there and say, listen, investing is about understanding what you're buying. What's the value of what you're buying? Now, people, like I said before, will attach a price to a value. If I went and asked 1,000 people right now, what's Amazon worth? You know what they say to me? It's worth $181 a share. No, it's not. It's selling for $181 a share. What's it worth? Well, that's based on doing analysis of the company. What does their balance sheet look like? What does the future of the company look like? This is why we have our stock analyzer tool. We take the future projections of the company, what we think, and in ours, I put low, middle, and high numbers because I don't know what the future is. It's unknown, and we're humans. We're going to make mistakes. So we make conservative numbers, more realistic and more aggressive numbers, lay it all out, and it's going to tell us, based on this calculation, what the stock would be worth to us today in order to get the desired return that we put here at the bottom. Let's look at Amazon's stock price. In the last 5 years, it's up 50%. But basically from August of 2020, it hit 175 and it's currently at 181. It is up $6, 3.5% since August of 2020. 4 years and 8 months ago, it has gone nowhere and it's paid zero dividend. But in that time, what's important to understand is this. This last quarter, I'm going to pull down their quarterly report. They did $188 billion in revenue and $20 billion in profit. Back in August of 2020, that quarter, they did $96 billion in revenue and $6.3 billion in profit. Almost double the revenue and 3 times the profit. And the stock is flat. What does that mean? Well, it can mean one of many things. It was massively overpriced before, and it's getting more intelligent now and fairly priced now. Or it was reasonably priced in the past, and now it's massively undervalued today. I'm not going to get into that right now, but the whole point is, why would it, if I told you 4.5 years ago, 4 years and 8 months ago, that Amazon's revenue was going to go up almost 2x and its profit was going to triple, would you have guessed that the stock would be down, would be even for that time? Let me go to a more extreme example. Let's go to Cisco. Back in 2000, Cisco hit an all-time high of $82 per share back on March 27th, 2000. It has not hit that price since. Now, you might be sitting there saying, well, Paul, I mean, come on. What about the revenue and profit? Well, in the last 12 months, they did $54 billion in revenue with $9 billion in profit. Okay, let's go see what they did back in the year 2000. They did $19 billion in revenue, so 1/3, and $2.67 billion in net income, 1/4. So since 2000, when it hit $82 a share, its revenue is up 3x and its profit is up 4x. The stock has not, and guess what, guys? It's not like the stock is selling for massively cheap. It's selling for 18 times free cash flow. Okay, it's got a good return on invested capital. That seems about right. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. That is the 4th tenet of our principle-driven investing. So back to bubbles. What are the 5 stages of the bubble? First one is displacement. This initial stage is characterized by new innovation, new development, some external shock that causes investors to become enthralled with the potential of a new asset or technology. And mostly it's always technology driven. Second one's a boom. So as interest grows, prices begin to rise. Initially a little bit slower, but then momentum builds as more investors join in, driving prices further up. That's the FOMO aspect. Hey, did you hear my neighbor made this money on this? Well, I'm going to go buy a little bit. Oh my God, it's up a little bit. Third stage, euphoria. So in this phase, caution is completely thrown out the window as prices continue to soar. It's driven purely by the belief that the good times will last forever. Investors are often willing to pay insanely high prices, and never do they ever say this price is too high. It's always some other price in the future that's way too high. And when it hits that price, you know what they say? Well, yeah, but things have gotten better, etc. Now, fourth one is profit taking. Now, some investors, some of the smart ones, sense the potential for a bubble burst. They'll begin to sell their holdings to lock in their profits. And this stage signals the beginning of the end of the bubble. Now, I look at Amazon going, is that part of it? The whole sideways movement for 4 years. Was it a bubble before? Again, I wasn't going to get into that, but it was selling kind of frothy. The 5th stage, panic. As more investors realize the bubble is bursting, panic ensues and prices plummet rapidly. Everyone thinks they're going to be the first one out the door. That's not the way it works. Guys, it's usually not driven by a specific company incident. It's driven by something that we don't see. As John Hussman says so eloquently in his videos, a room filled with gasoline, with a fire in the corner. There will be a spark that causes the explosion. We just don't know what spark that'll be. That's the amazing part about investing. And the part that I learned the hard way in the last 2 or 3 years. We don't know what's going to cause anything to happen, but we just know that it will. Now, how do you tell the difference between a real investment and a fad? This is what's difficult. Why? Because we all think that something goes up in price as an investment. When you buy an asset, it's an investment. Not necessarily. If I take a shit in a bag and give it to you and sell it to you for $5, you bought an asset. Does that make it an investment? No. And I always hear people talking about what an investment is. And an intelligent investor, they say, oh, an investment is one within which, doing enough research, you realize blah, 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 blah. I want to keep it more simple. For me, I read something one time that made perfect sense to me. It's an investment for me if I can buy it. And if the market for that asset goes away forever, I still have a way of generating some income and return based on that. So I look at that like companies. And you might sit there and say, well, Paul, I don't get income from a stock. Yeah, you kind of do. And here's how. Even if you don't get a check from them every single year in the form of a dividend, they're going to keep growing their revenue, growing their profit, and eventually pay a dividend or buy back shares and give you a bigger piece of the company. And the company over time will build in value as it drives its revenue and profit up. Now with hype, very simple. People will mask their hype as an investment by saying, oh, I understand what's going on here. I'm an expert in this. AKA Bitcoiners, crypto people. Oh, this is an investment because it's changed. No, it's not an investment. If the market for crypto and Bitcoin went away tomorrow, it would be absolutely useless. It would be gone and you would generate no income from it. You might sit there and say, well, Paul, how's it different than gold? Well, the difference with gold is there's other uses for gold. That's one thing. But I still don't buy gold because if I own it, I'd have to go mine it and do all these other things to make money from it. So I can't do that. So for me, it's not an investment. The US dollar, I can use it for buying goods and services. Bitcoin, sure you can, but I've been involved in a lot of real estate transactions. I've never had anyone even suggest crypto in any of those transactions ever. And I look at that going, man, I have businesses upstairs, I have real estate, all these things, and nobody's ever offered it to me. Could that be short-sighted? Maybe so. But the thing is, in those hypes and in those fads, you need somebody else to pay you a higher price. It's called the greater fool theory. You're the fool who owns it, and you need to find a dumber fool who's going to pay you a higher price for it. Now, guys, I've talked about these things ad nauseum in all of our videos, and I have what's called principle-driven investing approach. There are 5 tenets to it. I talked about one earlier. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. Now, if you want to get the full idea of all 5 of those tenets and explanation in it, click below. Give us your email. We will immediately email you a copy of our principle-driven investing PDF. It's a wonderful way, and I want you to take it and read it every so often. You guys, you have a reminder task on your phone. Set your reminder to read it once a week. You need to ingrain these things in your head. It's not going to happen by watching a video one time. It's only going to happen by immersing yourself in it. There can be investments that feel very speculative and feel like hype. For example, NVIDIA. Now, the great news is NVIDIA is better than GameStop, for example, or Bitcoin, because even though I think it's probably overvalued, and we'll know in the future, it still generates cash flow. It has a great balance sheet. It has a lot of staying power and a lot of future potential. Does that mean you should go buy it? I'm not saying that. What I'm saying is that you can have bubbles in investment types, just like real estate was a bubble for a while. It's when you get to that point of just massive euphoria, when you can't miss, you just got to own it at whatever price. That's always tough. And there are signs of this. I remember a few years ago, I was at a restaurant and my waitress telling me all about Bitcoin and how she just bought Bitcoin, all these things. Red flag. Now at that point, Bitcoin was getting close to 18,000 in its first leg up and it plummeted down to 3,000 or 2,000. But since then, it's gone back up again and much further. Why? I had to weed out all the crap. It weeds out the crap. People say it's dead. It makes a surge back up. Told you it was here and kept on buying more. It's easy to fall for these things. I used to fall for them all the time. I used to be sitting there going like, man, that person's so smart. And they told me this is an investment. Don't ever think that somebody just because they have money or they have a job in wealth management knows what they're doing. You have to understand the process. I want you to protect your wealth by learning how to think and act during these tough times. Dollar cost averaging is not sexy, but it's your secret weapon to win in market downturns. Yes, you'll still lose money, but you'll be buying along the way as things fall. The example I always give, QQQ. QQQ in March of 2000 hit a high for that time. Until August of 2002, it fell about 80%. 80%. But if you dollar cost average from the peak, watch your money fall 80% till today, you made about 14% return on your money, including dividends. That's incredible. Now, the QQQ is overpriced. Let's say it fell in half. This is still 10 to 11% return. That's what's incredible here. It's hard to do this, but you can invest in sexy things like QQQ and still outperform in the long run if you do it the right way. And you can still buy individual stocks, but my advice, everybody, is make sure you're hitting your goals before you buy individual stocks. And then with the extra money above and beyond your goals for retirement, go pick a few stocks, but you've got to be smart about it. You've got to sit there and have a smart, principle-driven approach to investing. Now, the hardest thing also is you got to ignore market noise. News follows the stock price. Your friends will mostly be wrong. You got to focus on what you're doing today, and it's part of a plan. Being part of the right community, having the right discipline, and a calm mindset is what wins in bear markets. Because you're not going to win. If the market's down 50%, newsflash, you're going to be down a lot. You could be down more than 50%. But you're building and sitting there and buying assets that when they're ready to explode will absolutely catapult out there. Crashes are not threats. They are absolute lifetime opportunities. You need to be part of that mentality that focuses on wanting those. Guys, this whole community is amazing. Our Everything Money community right here, these are made up of people who literally cheer on red days. We love the red days. We love the excitement it generates. It means things we love are at better prices. The stock market is one of the few areas where people run away when things are cheaper. I always ask everybody when they say, why do you like stocks being down? I go, what's your favorite thing in the world to buy? And they'll say something. I say, great, if it was half off, would you buy more of it? Well, of course I would. For some reason, people don't do that with stocks, but that's the way I feel about stocks. Now, next up, I want you to watch the video that's linked on the screen right now, because if you really want to take advantage of a market crash, you need to know exactly how to spot a great deal when you see it. And I've got a full course that I'll show you, my process step by step. I'm going to see you there.